They grew up on it.
It's the next evolutionary change in human development. It's the silicone gene, and not for augmentation purposes.
Okay, we're live now. I want to thank everybody for joining us this evening for Tuesdays with Terry. Tonight's guest is Kevin Crookham, the branch manager of Caliber Home Loans. And before we go any further, we're going to give people a few minutes to log on. I just want to mention that these episodes, they stay on our Facebook page forever. And every 2 weeks or so, I download them onto our real estate channel on YouTube. So you can always catch up, just scroll through the episodes and see if there's a topic there that interests you. And they're only a half hour long. And you'll find in the chats, you'll find, like tonight, you'll find Kevin's contact information. So you can contact him later if you have a question that we can't get to tonight. So let me take a minute and introduce Kevin. Kevin, I didn't download your bio, but I've known you for so long. Let me just say that I know that Kevin has, about 30 years in the mortgage business down here.
You're right, Terry. Yep. I tell my doctor and attorney friends I don't need to practice anymore.
I guess you've pretty much seen it all. This is definitely a new environment we're in now. Yeah. I do know that Caliber is one of the largest producing mortgage lenders in the state of Florida, and I know that you guys are on top of the latest mortgage news. So could you take a few minutes and maybe give us you or Caliber's take on the state of the housing market right now?
Yeah, I'd love to, Terry. Well, first of all, the housing market's on fire, partly because of record low interest rates. In my 35 years of being in the business, Terry, I started when rates were 18% in the early 80s, okay? And now on the other side of the rainbow, they're below 3% right now. We're writing 30-year fixed rate at 2 3/4, 15 years at like 2 1/4. And they are expected to stay low. Matter of fact, the Federal Reserve recently announced they're going to keep rates low till 2022. So this opportunity is going to be there for first-time home buyers for quite some time. So the housing market is really healthy. It's strong. The affordability of homes is made ever more so by low interest rates. But home values, it seems, the latest report I read today, the Case-Shiller report, said that appreciation in housing is starting to level off, but it's not going down and it's not going to flatten either. We're probably going to continue to see about a 5% uptick in value. So it's a great time to be a buyer. And unlike what you may think, getting a home loan is not that hard. We've got programs for everyone, first-time home buyer to repeat customers.
Well, let's jump ahead a little bit because that was one of the. Well, first of all, let me say it's interesting because houses are also selling quickly. I'm talking like 3 or 4 days. Yeah. A house goes on the market and you tell somebody and they're like, well, all right, let me talk with my wife and I'll get back to you, and we'll set something. Well, that house is gone by the time they get back to you. I mean, you really have to move quickly right now. So it's interesting. It's a good time for sellers and it's a good time for buyers. That's a unique period. But maybe you could take a few minutes and discuss some of the products that the Caliber offers.
Yeah, we have a full spectrum of loan programs, and in addition to FHA, the government programs, FHA and VA, VAs for veterans, that the advantage of VA is a 100% financing, zero down program. And we also have some unique products like what are called renovation mortgages for people who want to buy, an older home that either needs repairs or maybe it just needs a facelift. It's a home that was, built in the 60s. It's got yellow and green in the kitchen and Formica countertops and the old tile, and it just needs terrazzo floors, whatever. You want to upgrade it. So these renovation programs, which are available through FHA and Fannie Mae, are for people that just want to finance the improvements in their mortgage. So instead of having to worry about, after they close, where are we going to get the money to make these improvements, credit card or borrow money or whatever. It's one loan that has the financing to buy the property so they can close, and then after they close, they can make the improvements out of the additional funds that are in the renovation account. So that's a very hot product right now, particularly for, I think I read somewhere the NAR said that something like 65% of homes right now are more than 25 years old out there and may need, like I said, upgrades, or I like to say a facelift or whatever. So we're doing those products. We have some first-time home buyer bond programs through the state of Florida that if you meet certain criteria, you can get up to $10,000 of down payment funds. It is basically a second mortgage, and some of them don't have any payments on them, but you do have to repay it when you sell the home. But that $10,000 can obviously go towards down payment and closing costs. You have to meet certain income limits based on the county. You have certain credit score requirements and certain debt to income ratio requirements. But if there's anyone out there that's interested, I can go into detail if you want to contact me. The one area that we've seen most affected by the COVID pandemic is the jumbo market. That's the upper end market, above 510,000. These loans are not sold to Fannie Mae and Freddie Mac, so they don't have the implicit government backing, and so they're generally loans that are held by banks in their portfolio. So we've seen credit score requirements go up. We've seen a tightening up on debt ratios and other factors. So that market's been impacted by COVID. With COVID, now required to verify employment within 3 days of closing to make sure that you're still on the job. And if you've been furloughed or whatever, that can have an impact on your qualifying. But by and large, lending is strong right now. Most people are qualifying without issue. And like I said earlier, the quality of the loans are so much stronger right now. So, the housing crisis we had 10 years ago was fueled by speculation and bad loans. Now we make sure that people actually qualify. So it's kind of a novel concept, and we go over in detail, okay, where do you want your mortgage payment to be? What do you think your comfort level is? And what we try to do is customize a loan that'll meet those needs. Many times customers qualify for a lot more than they expect. And that's why it's important to focus on what's your comfort level. A lot of times a benchmark will be, what are they paying in rent right now? And so I'll ask them, okay, are you comfortable at that range, or can you go a little higher? With these low rates right now, it's easy to get a mortgage payment the same and sometimes lower than what you're paying in rent. So, like I said, it's a great opportunity.
A couple things that I wanted to delve into of what you just said. First of all, do you still have the calculator that people can type in the information?
Yeah, for the app for your phone.
Yeah.
I sure do. A lot of people love that.
Yeah, that's a good deal. Contact Kevin on that, and you can plug in the price of the home, the HOA fee, insurance. You can pretty much plug in everything. Um, do you think that when you brought up the real rehab loans, the 203K program, do you think we're going to have another round of foreclosures and short sales like we saw before?
I don't, Terry. Like I said earlier, the quality of the loans are so much better now. We're actually the lending industries become more responsible. Uh, Leading up to 2008, with the advent of these no income verification, no money down, you could be one day out of bankruptcy, no problem. We were putting people, the industry was putting people into homes that they really couldn't afford. Now we're not doing that now. So we make sure that the customer can qualify, comfortable with the payment. A lot of first-time home buyers, we make sure they get home buyer counseling. Some of the programs, like the bond program with the down payment assistance I was talking about, it does require home buyer education, which is usually an online course, usually an hour, 2 hour course they have to take, so they understand the responsibilities of home ownership. No, I don't think we're leaning into a short sale environment. There was some concern about the pandemic that a lot of people were being granted forbearance on their mortgage payments, and that could create a problem when they came out of forbearance. There's been a lot of misinformation out there about what forbearance means. A lot of the news is famous for getting this wrong. They'll report on, like MSNBC recently had an article where they said, ask your lender for forbearance. They'll stick the payments on the end of the life of the loan. Well, that's not what a forbearance is. Forbearance is a period of time where you don't make payments. At the end of that, let's say it's 6 months, you have to pay back the 6 months immediately, which is, we feared that was going to create a potential flood of homes that would have to be put on the market. Now, most of these homes have equity in them. So most of those people are not going to short sell because they have equity because of the appreciation. But what's happened is that the mortgage industry, in conjunction with the federal government, has gotten better guidance from the Fed as to what to grant forbearance or deferment. Many lenders are now actually tacking it on. Okay. So for somebody that's in trouble, that's what they need to seek, deferment, not a forbearance, because a forbearance is a temporary fix, and you'll put yourself in a real bad position at the end of the forbearance period, because that's when the lender requires all the back payments to be paid immediately. And what most people don't understand is the lender that services your mortgage is not the owner of that mortgage. So, for instance, Caliber Home Loans, we're one of the largest lenders in the U.S. We service 98% of our loans. So when a person closes with us, they continue to make their mortgage payments to us, which is nice because we continue the relationship. So I have customers after they close, if they have a question, they can call me or my team, and we'll help them with it. Okay. But it's Freddie Mac or Fannie Mae that actually owns those loans, or FHA, HUD owns the loan. We just service it for them. Mm-hmm. So we have to follow their lead on these forbearance scenarios. But no, to your question, Terry, I really don't think we're going to see a wave of short sales.
When we were talking about the rehab loans, I would say to people out there that I don't suggest it for a house that needs a lot of major repairs. I suggest it for, like you were saying, a house that needs spruced up, a house that needs painted, because um, you'll see that sometimes that money doesn't go that far. And I think it's, in the last round we had of the big foreclosures. I mean, you saw houses, especially when people left that weren't very happy. They trashed the house. You needed a whole new kitchen. You needed a whole new bathroom, and $35,000-$40,000 doesn't go that far when you're using licensed bonded contracts. So I think it's a great product uh, to spruce up a house because that money can go real fast.
Yeah, and we do a like a feasibility study when we do these loans to make sure that the budget allocated for the scope of the work's adequate to get the work done, and then we also build in a 10% um, extra cushion in case there are cost overruns. But to the renovation product, the FHA product is 35,000, and that's ideal for, like you said, minor like stuff. There is a full 203K that you can go up to, $100,000 in repairs. That requires, a architect, sometimes an engineer, depending on what you're doing. It's a much more involved loan. But the important thing is for people to understand that these are available. A lot of times you'll see homes listed, and in the MLS they'll say cash only because
Right.
the property's in bad shape. The listing agent knows, hey, it's not going to meet lending guidelines. But a lot of listing agents don't know about these products like you do, Terry, that, you can actually buy a home that doesn't meet lending guidelines as long as you use one of these renovation programs.
Yeah, and sometimes it's just a lot of small things rather than if you have a hole in the roof, um, you should either you should move on to a new house. Actually, it sounds like this is really a good time for people to refinance. Are you seeing a lot of that?
Oh, it's the bulk of what's going on right now in the mortgage industry. We're seeing a record amount of requests for refinances, and matter of fact, the Mortgage Bankers Association did a study recently, and they realized that anyone that has obtained a mortgage in the last 12 months, 65% of those people would benefit from a refinance. That's how much rates have dropped. So, like I said, we're writing loans in the upper twos right now for a 30-year fixed rate. So if you're at least 1% higher than that, rule of thumb is a 1% drop is the minimum that you need to benefit, because you're going to have some closing costs, which can be financed, but you're going to be tapping into your equity to finance that. So at least a 1% drop, and you're going to live in the home for at least 2 or 3 more years to benefit from it. But yeah, right now refinances are probably about 70% of the volume right
Wow. Now, has if people may be listening or listening later that may be interested in refinancing, but also took not a forbearance, but putting the payments to the end of their loan. How does that affect them now if they want to refinance? Do they have a waiting period that they can refinance?
Well, that, Terry, I don't know the answer on that one. I do know the one on forbearance. If they're in a forbearance, they do have to bring the forbearance current
Mm-hmm.
In order to refinance. Now, initially, the government was saying that in order to refinance, you have to have 12 on-time mortgage payments, which anyone in forbearance wouldn't have 12 consecutive payments, right? Because they didn't make payments.
Right.
Now, even though it's not reported as late, it's reported as not having been made because of forbearance. So the government decided, after realizing the impact of that they said, okay, you can still refinance. We're not going to hold that against you if you're in forbearance, but you have to bring it current with your own funds, and then you can refinance. So, yeah. But we're not, it's funny. It's funny. I was reading this morning in the Wall Street Journal this article about jumbo mortgages and how the banks, for the longest time, offered jumbo rates lower than the conforming rates because they felt that the upper end buyer or borrower was more creditworthy because they had more assets and more income and all that. Well, guess what? Wall Street Journal reported this morning that there are more jumbo loans in forbearance than there are conforming. 10.1% of all jumbo loans are in forbearance versus 7.3% of conforming loans.
Wow, that's interesting.
Yeah, very interesting, isn't it?
Myth. One of the things I've noticed is, especially working with, with first-time home buyers and stuff. And this is what's interesting about your calculator because it actually calculates the private mortgage insurance. That really drives the cost up of the payments sometimes. Could you explain what the mortgage insurance is and who needs it?
Anyone who's putting less than 20% down on a conventional mortgage is required to have mortgage insurance. And basically what that is it protects the lender. In this case, let's say it's Fannie Mae or Freddie Mac, in a foreclosure. So if you default on your loan, goes into foreclosure, the home is sold in foreclosure, but not enough money was obtained at the foreclosure auction to pay the loan off, the mortgage insurance company pays the difference to Fannie Mae for any loss in the foreclosure. There is a percentage that they pay. They don't pay the entire loss, but they pay a good portion of it. But if you put 20% down, it's not required. On FHA loans, which are government insured loans, they require mortgage insurance regardless of how much you put down. But generally, people doing FHA or first-time home buyers putting a small down payment, so they're not putting 20% down.
Right.
The mortgage insurance is not forever. There are guidelines about how you can eliminate them or cancel the mortgage insurance. Generally, it's after 2 years and a good payment history. You ask your lender to order an appraisal through one of their appraisal department, and if the value of the home and or the balance of your mortgage or both, have the mortgage balance has gone down, home value has gone up, and you're at 75% loan to value, then the mortgage insurance is eliminated. If you've had the loan 5 years, you can do the same thing, but then you need a loan to value of 80%.
Houses are selling so quickly right now. We talked about that. How would you advise somebody that is ready to purchase a new home, is creditworthy, but they need to sell the house that they're in now to purchase a new home? And in the market right now, I don't see a lot of sellers accepting any contingencies because they don't really need to. They're getting multiple offers on every house.
That's right.
Is that selling your house or purchasing a house while you have to sell a house? Is that still a viable option, or are there any other options for these people that you can think of?
Well, if we have a lot of customers in this situation, maybe the first time home buyer is now ready to buy up to a bigger home, maybe because they started a family or whatever. Ideally, if they qualify carrying their old house payment with the new mortgage that they're applying for, and they don't need any money from the sale of their home, then what we do is we approve them carrying both houses. Okay. And but if they don't qualify, that's where it's an issue, because usually it's one of two things. They don't qualify because the debt to income ratio is too high because they're carrying two mortgage payments.
Right.
And or they need the equity from the sale of their home for the down payment on a new home. So, but with these low rates right now, we're finding more and more people that are often able to qualify carrying both payments. And, I've had a couple just recently that sold their home, their old home, after they closed on the new home. And they called and said, hey, can I put that $100,000 towards my new loan and lower my payment with you? And yes, we will do that for you. So that, if they can qualify by carrying both payments and they have enough money to put a down payment on the new home, then that's not an issue.
Great, because I think that's where a lot of people are at right now. We're almost out of time now. I just want to remind everybody that Kevin's contact information is in the chat. If you want to call and get some advice for him on a mortgage or to download his app, he'll be glad to work with you on that. Is there anything you wanted to touch on that we haven't broached yet tonight?
Well, Terry, I think we've covered it in a nutshell in 30 minutes. Like I said, and like you offered to any listener, if they want to get more information, they're welcome to call me anytime. And, I can give more details on some of these programs.
We're going to sign off on Facebook right now. Kevin, stay on Zoom for a couple minutes, if you will. And I just want to remind everybody that these things are available for later viewing right here on the Facebook site that you're on. And we hope to see you next Tuesday when we'll have another guest. Thanks, everyone.